welcome to a new episode of the Insilico Terminal podcast. Today I have with me Trader XO, and we have a bit of a different setup this time, a bit more of a professional setup, I guess. But I guess first, for people that don't know you, could you introduce yourself, who you are, what you do, what you have for us today?
Yeah, sure. So I'm Trader X, so fairly pseudo-anonymous. I've been in the trading space since 2016 when I first bought Bitcoin. Ever since 2017, I've been actively trading the markets. I've been through the highs, I've been through the lows, all the emotions associated to trading. But I have to say, looking back, next year is going to be my 10th year. It's been one hell of a journey. Uh, I'd recommend anybody who's looking to start out, keep well away from trading. No, but it's just such a mental, emotional toll more than anything, and it can really wreak havoc on your lifestyle. But we'll talk about that in the stream today. But I think at the end of the day, um, I think if you're truly committed to the game, then you can have a lot of success as well.
Yeah.
Prior to that, I come from a tech background. I graduated in computer science with mathematics, and I mastered with computer science with cybersecurity. Worked in investment banking as a software developer for 10 to 12 years. And decided to step away. Like I said, I bought Bitcoin in 2016, started trading in 2017, made a lot of money, lost a lot of money, went back to work because I sucked at trading for a while, and then finally sat down, and it was in late 2018 after losing a lot of money in the bear market that I started to figure out in building a trading process, which really laid the foundation of kind of where I am today.
Yeah, sounds good. So what do you have prepared for us today? The first real prepared guess. I'm interested.
Yeah, so I think for me, as opposed to just having a podcast about me, and how great I am and how shit I am or whatever it is, it's just basically about, well, look, why don't we do something different? And I think it's more about sharing my journey in trading, but really giving back to the community as to where or what I've incorporated that I hope can inspire somebody else to follow a similar path or find today's stream useful. And that is the trading process. And I think, like I said, having entered the space in 2017, I've wrote about it on my Substack. I made a lot of money, and a lot of it was down to luck. It was a bull market. Everybody's a genius in a bull market, but when shit hits the fan and you have no understanding of risk management, you have a lot of emotional attachment to whatever your assets you're in. You've got a heavy emotional bias for them to perform well. Anybody who talks badly about Bitcoin going down is ridiculed, and I was one of those people. I was an absolute permabull, very emotional about my trading, to the point where I lost a lot of money. Thankfully, it wasn't. I didn't lose my initial. I kind of doubled my initial at the end of it when I stopped trading in 2018, and that was it. At the end of October, I sat down after losing some money in leverage trading as well. On BitMEX, I've got some Bitcoin in the insurance fund, but sat down and decided I need to stop doing what I'm doing, because whatever I do, I can make a little bit of money, but then I'm taking some really large losses, and I don't know if this is the career path for me. But let me be really structured. Let me really think about how to approach this game as a professional, and discard everything that I've learned or have understood about markets, because a lot of my performance prior to that was just randomization. It was just pure luck. It was just pure fundamental analysis. Everything was going up. So you could kind of throw a dart at a dartboard blindfolded and kind of hit jackpot. That's how markets were for the best part in 2017. And so, in today's session, I wanted to talk about the importance of a trading process, and why for me it was kind of the defining point. And it's everything that I've built upon year after year after year, which has got me to where I am today. And what I'm excited about the most is not where I am today as a trader. It's knowing how much more potential and how much more I can get out of my game in the next 3, 4, 5 years, where each year on year I look at my performance, I just feel as though I'm getting better and better and better as a trader, and I'm becoming more humble, more objective in my thought process, whereas it's very easy for traders to marry a bias and lean towards predictability as opposed to appreciating the random nature of the market. And we can't control the market. We can't really predict what the market is going to do. But it's more about understanding who you are as a trader, understanding your edges as a trader. But ultimately, um, I think I said it before that a lot of new traders anchor their trading around learning the technicals, whether it's price action, whether it's Elliott waves, whether it's order flow, footprints, the DOM, the ladder, a bit of fundamental analysis. Unfortunately, I've been through that same journey, and I can tell you it's not the be all or end all of trading. It's just a small subset or a small segment of what you require to succeed in this game as a discretionary trader.
Hmm.
And so the reality of trading is such that over 80 to 90% of traders fail. And it's rarely due to a poor strategy. I could give you my strategy, somebody could give me their best performance strategy, but the chances are, if I don't have a process, if I don't have a routine, a structure, if I don't understand risk management, then the chances are I'm probably going to lose a lot of money very quickly. And because of that, the statement that I've put here, more often they blow up because they don't manage risk. It's not the market that takes them out. It's often themselves. And we saw that on 10 in 10th of October. How many traders did we see, obviously anonymously and on Hyperliquid, just blowing up across the board? The liquidations were brutal on that day. And
Yeah.
and what does that come down to? Was it their strategy or was it really themselves, their risk management, their emotional bias, their emotional attachment to their positions, and not recognizing the risk in the markets once price started rolling over? So it's unfortunate, but the reality is that 80 to 90% of traders fail. And so when you're in this game, you really have to ask a question, well, what are the 80 to 90% doing that's causing them to fail? And in this game, when I refer back to the book by Tom Hugard, Best Loser Wins, and he states how normal thinking does not win in this game of trading. You really have to think differently and approach the entire game of trading differently to what the majority do. And if you think about Pareto's principles or Pareto's law, 80-20, 80% of traders fail, 20% make money. And even as a trader, as a discretionary trader, the bulk of your money in a year probably comes from 20% of your best trades. The other 80% is just you churning away, churning away, churning away, going sideways, going down, then slightly up until you hit, a couple of very good asymmetric plays. So that's the reality of trading failure. And one of the reasons why I feel traders fail is because we don't understand markets. Markets are unpredictable, but we can learn to understand them. No one can predict market moves with certainty, and I think that's a common flaw that many traders try to do. We all marry a bias. We've all got arrows pointing towards the chart that no, price is going to do this. There's no chance price is going to drop, to whatever level lower down. And that's not really objective. Anything can happen at any time. And we saw that. Again, I keep talking about October the 10th, 2025 across
Yeah.
crypto. I've pretty much lived through every major cascading liquidation events since 2017. And touch wood, I've survived every one since 2019 because for me, it's understanding that at any point the market can do anything. All it takes is one bad day for me to be wiped out on my trading balance or my trading account, as opposed to all the other days where I've done really well, I've grown my account, but it's just that one day and it comes down to survival. And some of the risks in the market are global events, war, policy changes, economic shifts. We saw what happened with the COVID crash. The market breaks out. It has forced liquidations if liquidity is very thin, or cascading liquidations on the way down, which we saw. And then you've got external risk factors such as exchange hacks, financial system shocks, interest rate decisions. And so there's always a level of risk in the market, and markets do not like uncertainty. And at any one point, as soon as there's a high level of uncertainty in the market, there's likelihood of a risk event. But with that risk event, if you can read it and if you can play it correctly, you can capitalize on that. And so it's about embracing uncertainty. Even the best analysis or setup can be disrupted by unexpected events. Market moves are unpredictable, and there's a high degree of randomness. And so what I've learned over the years is just be humble, be open-minded, and stop speaking in absolutes. The minute you start doing that and you start becoming more objective about the markets, you then appreciate that this game is all about survival. Risk management first, risk, 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 and then you can think about taking the trade. But the mindset has to be there, is constantly questioning where is the risk in the market that's going to cause me to be offside? Whether you're long, whether you're short, where is that evolving risk likely to occur and where or why? What are those drivers? But you have to be balanced because obviously, if you're too hesitant, then you're going to fail taking risk. And your primary job is a risk taker, but in a calculated way. And that's kind of where you have to embrace randomness because many traders struggle because they don't fully accept market uncertainty, and that leads to stress, frustration, poor decision making. We've all done it. We've all oversized or undersized. We've all hesitated on trades. We think the market has to go in certain ways, so we oversize and then we get taken out. I've been there myself many times during 2018, 2019, and parts of 2020. And so really a lot of this trading decision making comes down to emotion. It's not a systematic way of trading. It's emotionally led, which causes a dreaded reaction in your performance, which then gives this negative feedback loop that you're perpetually in this loop of failure because your trading is wrecked by what you think is technical decision making isn't. It's actually overridden by a level of emotional hacking of your performance and of your game, which is impulsively causing you to make bad decisions, from oversizing to cutting the trade too early due to a lack of fear. So there are various factors that we have to think about, and the key to all of this is just appreciating the randomness in the market. So that's the power of objectivity. I talked about objectivity earlier. Is accepting that uncertainty reduces stress, fear, and emotional attachment. And staying objective allows you to see the market clearly without a bias. Over the last 2-3 years now, I really don't care whether the price of Bitcoin is going up or going down. All I'm looking for is long opportunities at key inflection points and short opportunities. That does not make me bearish or bullish. Price could be in a downtrend and I could still be looking for longs at key support. Price could be rallying and I'm looking to hedge out. Does that make me bearish? Not necessarily. I'm just objectively thinking about the risk to reward profile for me as a trader, for my system, for my performance and who I am and my personality. So the market isn't personal. It simply moves.
Yeah.
And your job is to respond and not to predict. So I've highlighted objectivity, embrace this mindset. And so what is the truth about trading? When you ask traders out there, what is trading really about? And you'll be surprised, including myself, if somebody asked me this question back in 2017, 2018, what is trading? Ultimately, what does it come down to? And it's all under the umbrella of expectancy. Expectancy is your win rate multiplied by your average win minus your loss rate times by your average loss. And what is edge? What is edge? Edge is having positive expectancy. And if you don't have an expectancy greater than 0, then you do not have a profitable system. If your expectancy is just above 0, then you do have a slight edge. And you can work on refining that edge to enhance that performance, to enhance that edge and to increase your expectancy. And a lot of people attest expectancy to a trading strategy. It's not just about a trading strategy. The trading strategy is just one part, which we'll cover in today's stream as to a series of submodules in what I like to call the trading blueprint or the trading framework or the process. And that's what trading comes down to. It's about, do you have edge? Do you have positive expectancy? Everything else is irrelevant. It's all about expectancy at the end of the day. And so then it comes down to, well, what is edge? Well, edge is your ability to read the environmental market context. It's your speed of understanding. It's your discipline, your risk control, your pattern recognition, your ability to stay objective. That's what defines edge for me when I think about all the things that develop edge. And even when we look at today, we've got the advancements of GPTs and LLMs, informational edge feeds into the overall edge of you as a trader. How are you taking advantage of that technology? Are you using indicators? Are you using custom scripts that you've built yourself? Are you building screeners and scanners? Because how often, right, as traders, when we begin, we're looking for opportunities all over the place. Well, if you've got a very good screener and a very good filter for one of your strategies, now all of a sudden you're not trying to find what the next trade is. Those trades are coming to you. And so, therefore, that is a level of edge. That's informational edge. You then have in front of you what is a set of assets and markets that you can decide, all right, you know what? According to the rules that I've defined on my filter or scanner, this could be a very good trade for me because it aligns, because I've built this scanner on filter system for this strategy. And then with that, you've got other scanners and filters rule based, which are aligned to the various strategies that you deploy that you wish to trade in a given context as well. So that's what understanding edge is for me. And so when I talk about my past journey, where I was as a trader in 2016, 2017, 2018, 2019, this was me on the left. And it wasn't until, like I said, I stopped trading. There was a period where I stopped trading. I didn't take any trades for 3 months. I sat down and I built a trading manual. And that was really difficult for me to do because you really start questioning who you are. You learn so much about yourself. And there are questions that you ask: what are your strengths? What are your weaknesses? What are you looking to achieve from the market?
Yeah.
What are your objectives? What's your daily goal? What's your weekly goal? What's your monthly goal? What's your yearly goal? What's your daily routine look like? What does your weekly routine look like? What does your monthly routine look like? And so all of a sudden, you start realizing that whereas before you'd come to the desk, you come to the chart, mark up a few levels, you don't even think about position sizing, or do you know what, I'm just going to whack some money onto this trade. You don't even think about risk. You don't even think about where you're invalidated. And so basically, all you're doing, and I think I've mentioned this in the past, is that everybody can trade, but not everybody is a trader.
Yeah.
Right. And I've attested to this. Like, you can put on a pair of boxing gloves and you step into a boxing ring. You're boxing, but are you really a boxer? Because you don't have the skill set, you don't have the discipline, you're not doing the bag work, you're not doing the rounds. And so when you understand and accept that, well, trading really is a form of professional sport. And that's one way to look at it, because which other industry or career path out there, and I've talked about professional sports, MMA, you can't go to an MMA gym and spend 6 months there and expect to fight in the UFC against pro elite level fighters. You're going to get knocked the fuck out. So why is it any different with trading? Just remember that here's a market that it's easy to get some money, deposit onto an exchange. The minute you are about to trade, just know that you are competing against some of the best algorithms, some of the best systematic traders, some of the best funds, some of the best discretionary traders. Do you really think you've got a chance to outperform some of the best in this game day in, day out, week in, week out, month in, month out, year after year after year? Or is the likelihood that they're just going to come take your money away from you, and then you're probably going to be depressed thereafter and you probably quit trading? And that's the reality. Until you accept that this is what it actually is, this is what you're doing, you are entering in an arena which is a level playing field for all, and you're up against some of the best. And so that's why I come back to the start. Why is it that 80 to 90% of traders fail? Well, because normal thinking and having a normal approach to trading does not work. And that's the wake-up call. That's reality. If you're not going to do anything about it, then don't fucking waste your time. You're going to fuck up. You're going to blow out, just like I did, just like how many others before me have done, and those who have come after me, they've probably experienced similar losses. And that's just the reality. This is a very ruthless game. But if you approach it with a level of structure, discipline, process, understanding every facet of discretionary trading, then you give yourself a decent probability that you have to find where you have edge. And that takes time. That really takes time. And so what I came to develop over the years and what I've come to understand was the trading process. And for me, these are the core segments of everything that I do today, which has incrementally evolved over the years since 2018. So what is that? It's about understanding yourself. Then you've got the psychology and the mindset of trading, because like I said, how often do we see the psychological aspects of trading really harm the way we trade?
Hmm.
How often do we see traders revenge trade? They take a few losses, they're going to oversize because they're trying to make it back on the next trade. Or a trader has taken three, four losses in a row. They're down 6, 7, 8% on their account. And now when the next A plus trade comes staring at them, they've undersized
Yeah.
or they fail to pull the trigger. That's not good trading. And that undersizing or you failing to pull the trigger, even though the setup was screaming at you, is not because of your strategy, but simply because the emotional side of trading is damaging your performance.
Hmm.
And we then talk about routine and goal setting, which I'll cover some of these segments in today's streamer, and then the kind of a high level. I'll go over each in high level detail. The one that I'll skip is technical proficiency because I think that's more subjective to technical analysis, order flow, reading the market,
Yeah.
and we'll finish off with strategy testing. But ultimately, these are the segments that I think is that if you just remove one segment from out of here, I think it affects your trading. It certainly does with mine. If you don't journal, then how are you ever going to evolve as a trader? You don't know what your performance is like. So how are you ever going to perform really well? And I liken it to, if you're bodybuilding and you're into aesthetics, right? You are
Hmm.
going to follow a very strict routine. You're going to eat at this time. These are your macros. These are your macros. This is your calorific intake. These are the workouts that you're going to do today. You journal it, how much you lifted, and you're looking for that week on week progress. One day is going to define your body, but 1,000 days in the gym over a period of 3 years, you're going to see drastic changes if you stick to your routine, if you stick to your process. When you come off your process, fine, there's going to be the odd day you come off your process. It's not going to make too much of a difference. And that happens as a trader. You'll never be on your process 100% all the time.
Hmm.
But you've got to recognize that, like you have a cheat day, oh shit, this was bad trading. I fell off my process. I need to get back on it. Let me review. So each segment is ever so important. It's understanding yourself. If you don't know why you're trading or what your objectives are, then why are you in this game? What, because you want to make a lot of money? Well, yeah, no shit. We all want to make a lot of money, but it's about really understanding who you are and what your strengths are, what your weaknesses are. Are you a scalper, swing trader, day trader? But why?
Hmm.
Why are you a scalper? What makes you a good scalper? How do you know you're not actually a good positional trader? Um, so we'll talk about each one of these, and ultimately mastering the process is about mastering yourself. It's a refined process, and you can't expect to just come out with a process 1 year and be absolute brilliant in the market. You've
Yeah.
just got to respect the fact that it takes time to develop. You really have to approach the game as a professional. Even though you're a retail trader, which many of us are, we're discretionary traders, it takes time to develop. And I liken it to a university degree. We've both done computer science.
Hmm.
We've spent 3 to 4 years at university. We've done various modules, but after doing all the modules, is it only at the end that we decide I want to become a software engineer. I want to become a database administrator. I want to become a network engineer. I want to become a cybersecurity specialist. Yet all the other modules that you did at university, some of them may have relevance, others probably won't. And I feel that's how trading is, that there's no way that you can understand yourself, experience all the psychology aspects, understand what a routine looks like, risk management, technical proficiency, developing various strategies, creating a playbook, having trade execution, and then understanding journaling in the space of 6 to 12 months. I just think it's a very, very tough feat
Hmm.
unless you are under the guidance of a professional trading firm with some professional traders, and it kind of speeds up your learning curve. But quite often we don't have access or the luxury to prop firms or trading at a hedge fund or trading at a desk as a proprietary trader. So it really takes time to develop all these various skill sets. And it's really all these skill sets that you're developing. It's you that you're trying to develop as an individual more than anything. So, every segment builds towards developing your edge. And that's why if you miss one or two out, I think you're just setting yourself up for failure.
Yeah.
And it's your ability to read price, rhythm, flow is a direct result of your process. Right, you can read the market. Everybody's a great analyst, right? On Twitter, we see everybody marking order blocks, supply, demand. Oh, look, I called it, I nailed it. Well, how much risk did you put on that trade? How did you size up for that trade? What was your execution trigger? How did you scale into that trade? Did you limit chase? Did you TWAP? Or was it just randomness? You just thought, oh fuck it, I'm just gonna hit the buy button and let's see what happens. That's not really, you can do better than that. It's easy to fall into that trap of fuck it, let me just smash market buy, let me just put some limit orders here. Well, why are you putting those limit orders there? What are you actually looking for in that execution process? And we'll talk about that in today's session as well. But ultimately, trading success comes from self-mastery, not just mastering the market. It's more about yourself. And I just feel as though technical proficiency, understanding price action, order flow, you can be a brilliant order flow guru, but you can't trade for shit. Why is that? Maybe because your psychological aspects of your game is damaging your performance. Maybe you're a degenerate. How often do we see people on Twitter sharing 700k P&L wins, but as a result of that, it's come out a 40% drawdown. So how long or how soon is it that it's only a matter of time before they blow up? Because a 40-50% drawdown on a level of degeneracy, you can't repeat that over 1,000 times. And I always say that you can't scale up randomness, and you can't scale up a high degree level of variance, because eventually the market is going to find you out. And it's not that the market's going to find you out. It was upon yourself, because you didn't really have a true framework for trading the next 1,000 trades, and incrementally reviewing your performance, which is where journaling comes in. How do you know what your best setups are? How do you know what time of the day you're performing well? How do you know which setups you should be leaving out? So it really gives you a lot of structure, I feel. So that's kind of the core tenets of what I think is key to a successful discretionary trader, whether it's a day trader, intraday, intra-week, positional trader, swing trader. These are the facets that I feel that have helped me really get to the levels where I'm at today. But it's also that these core foundations are going to help me propel to the next level and the level after that as to where I'm going. So there's a logical progression to where I want to be. And as traders, every year we're always evolving. We're always trying to get better. We're always learning something. And if you think of the hockey stick curve, for the first 2, 3, 4 years, you're experimenting, you're tinkering, you're figuring out various systems. Then eventually, once you find that there's a strategy with a high degree of positive expectancy, that's all you need. For as long as that edge keeps working, you have edge. You've got positive expectancy. You are now able to extract money from the market, and your performance will improve as you develop your skill set over time. But I mean, so far has what I've said made sense to you, essentially, with kind of the various segments in trading, why they're really important. They all complement each other. And so if you're looking to improve as a trader, you've really got to have an appreciation for each one. And like I said, I don't think you can really truly get an appreciation for every single facet of trading until at least a good 2-3 years. And with that really comes a large level of deep learning, discovery, finding, understanding psychology, mindset, understanding what is routine and goal setting, understanding the various types of risk management frameworks, because within risk management, you also have trade execution. With technical proficiency, well, that's your analysis of the market, your read of the market. Can you read the market in real time? Do you understand microstructure? Or maybe you're more of a swing trader that relies on moving averages. Well, do you understand every nuance of the tools that you are using, which form various strategies that you're looking to trade.
Mm-hmm.
And then obviously you go into strategy testing, trade execution, because once you have a strategy, part of that strategy, you've got trade execution as well. And then all that goes into iterative journaling. Do you how you plan the trade? Did you follow your process of planning, executing as you intended to? Did you see the patterns of execution? And so it's an iterative process, and that's just for one trade, the entire trade life cycle.
Mm-hmm.
And then you've got to repeat that over again and again and again, and look at your weaknesses, find your strengths, remove your weaknesses, or understand your weaknesses and why that's slowing you down in your trading or holding you back.
Mm-hmm.
So that's why I think each tenant here is very, very core to elite trader performance.
I think you did a great job in summarizing all of this, what is part of the process, and like displaying it and talking about it in a very coherent way. Like it makes a lot of sense to me, and I think it, like most of the time, people usually talk about maybe technical proficiency most, like what kind of tools they use, or like a little bit of risk management and like the psychological aspect. But I think you really like nailed it down in making all of these like a core tenet of what it actually takes to be successful in trading.
Yeah, thank you. Yeah, it certainly helps, and it's just having a level of appreciation,
Mm-hmm.
and it does take time. It does take time. With some guidance, you can get there, but you've really got to dig deep and understand each of these facets of trading. And so then it comes to, like I said, understanding yourself. I'm not going to spend too much time here, but this is where I created a 60-page trading manual, um, of which some of these questions were: what are my strengths? What are my weaknesses?
Mm-hmm.
How do I work under pressure? Do I thrive in structure or do I prefer flexibility? And I think it's a very fine balancing act. It's really more about understanding you, your personality, and then understanding what type of strategies or what type of trader you wish to be, you want to be. And then in terms of psychology, Sonny, we'll talk about the second segment, which is psychology and mindset.
Mm-hmm.
I'm not going to spend too much time on this, maybe 5 minutes, but a lot of people say you've got to control your emotions. And I think that's a really bad way of understanding the emotions of trading. You can't control your emotions. And by controlling your emotions, you're just basically trying to suppress what is just going to keep surfacing time and time and time again.
Yeah.
So when it comes to understanding trading psychology, you've got to have a level of awareness, self-awareness during the entire trade process. So when you're planning a trade, when you're mapping a trade, when you're marking out your levels on the chart, you'll notice that your emotions are relatively calm. When you're going through your process of, whether you follow a structured process of daily morning pre-market prep, your emotions are fairly low. You're just planning the day ahead. You're planning the possible trades ahead, but
Mm-hmm.
your emotions are heightened when during the point of execution, when prices come into your level, your emotions are generally heightened. And if you don't have structure in your trading, this is what I've come to understand. If you don't have structure in your trading, where you don't know how much you're going to risk, you don't know what position size are, you don't know what your execution trigger is, you're blindly punting on a level. Of course, you're going to be emotional when you
Mm-hmm.
hit the trade. How often, right? We've probably all done this. You've entered a trade, price is reacting, it's come down, you're offside, just marginally, but you've cut the trade. 1 hour later, price moves. It finally takes off, left you
Yeah.
behind, and then you start chasing it.
Yeah.
Or how often do you see when price, you've nailed the entry, brilliant, you're calm, you're collective, price pushes away. Oh shit, I think it's going to come back down and stop me out.
Mm-hmm.
You start quitting the trade because you think you might get a better entry, but price pushes up even higher. Now, was that emotionally driven trading? Because if you were looking to quit the trade, that's a fear of losing.
Mm-hmm.
The flip side to that is great. Oh, I think this is going to be a brilliant level to trade. Let me really oversize.
Mm-hmm.
Or greed in the sense, or revenge trading. Fuck, I need to make back some of my losses. And then you go on a tilt. So really having a self level of awareness and understanding that during the point of execution, write down soon after how you felt during the trade execution, during the trade management. Just get a pen and paper on a sheet and write down your emotions for the day whilst you're actively trading. Even before you take the trade in the morning, how do you feel? So you've got to have a level of observational aspects of looking at yourself as to who you are. And, I'm not going to repeat some of the pointers here, but you can see that you've got to recognize emotions in real time. It doesn't mean that you can stop them because emotional patterns have strong momentum. Initial recognition may feel like control, but it's just often a temporary effect driven by novelty, not real correction. And true change requires more than mapping your emotions. You need a deeper performance review, and you've got to dig out your flaws. It's like when you've got weed going through the ground. You can spray some weed killer on it. Fair enough, the weed might die, but it resurfaces again. That's a classic example of your trading emotion. You might think you control it. You're all right, you try to control it,
Yeah.
but it resurfaces again. The true aspect is that you have to get down to the root cause of why is this making me feel this way when it comes to trade execution? Why am I suffering from fear, from greed, from revenge? What's causing that? And then you've got to think about, well, if I keep doing this, how is this going to affect me as a trader in the long term? And then the fourth part is, all right, what do I need to do now to stop feeling this way? And sometimes it's as simple as understanding risk management. All right, for each and every trade that I'm going to take, assume you're on a bad run and you risk 1% per trade. You take 6 trades, you take 6 losses in a row, you're down almost 6%. Now, if you're suffering from trading performance psychologically and you know that your strategy is fine, then reduce your risk to 0.5%. You take 6 losses in a row, you're only going to lose less than 3%, if that. And now all of a sudden, losing 3% after 6 trades doesn't feel so bad. And if you're risking too much, say you're risking 2% and you're in a 6 trade losing streak, well, you're down 12%. And even then, if you've got poor risk management where you didn't really respect your stop losses or the amount that you were willing to risk, you're going to lose 30% in a matter of weeks because you didn't adhere to your risk management levels. So risk management and survival is really key, and you've got to recognize how emotions can play or have a real impact on trading performance. And so, like when you think about trading performance, you've got to think about it as a bell curve. Now, I learned this concept from The Mental Game of Trading, a book by Jared Tendler, really fantastic book.
Okay.
That really gives you an actionable framework to work on your trading, especially from the mental side. And I just want to say one thing, that you can't just go away and think, all right, I'm going to start working on the mental game of my trading, because if you don't have a system or a strategy, then what the fuck are you working on? Are you working on yourself, or actually are you actually working right? Okay, here I am as a trader. I understand who I am. Here's a strategy that I trade. I'm having issues trying to execute the strategy because of the emotional aspects. I have got some edge, but the emotional side of trading is not allowing me to execute as per all my back testing and forward testing that I've done, that in the real environment, I keep fucking up. So the strategy is actually fine. The issue is the emotional aspect. And so it's about digging deep into your emotional side. And there's 2 sides. So you've got your mental game of trading. Are you confident? Are you relaxed? Are you patient with a purpose? Being patient and being disciplined basically means that you are following a strategy with a positive expectancy, or a level of positive expectancy with an edge. And so, like, and many people can relate to this, because when you've got your BK and prices coming to your level, are you hesitant? Are you second guessing? Are you reacting too slow, too late? Did you fail to pull the trigger? So that is actually not a technical issue. That's the emotional state that you have to appreciate. And then your C game is, you're just being lazy, you're distracted, you're probably out and about, you're trading on your mobile, you decided to take a trade, you didn't put a stop loss in place, and you're trading your P&L. That's just dog shit trading. You carry on doing that for the next 2, 3, 4, 5 years, you're probably going to blow up quicker than you know it. And then you've got your tactical game, which is do you understand the current environmental context? Are you aware of what it is that you're actually looking for in terms of an execution trigger? Are you letting price come to your levels? And then you go to your B game, which is somewhat substandard. You're taking too many attempts on the trade, because you don't really have a true execution process. You don't have a repeatable process that you've back tested, forward tested, that you've seen play out in the market over and over and over and over again, right? Because how do you build performance? How do you enhance your performance? Just like a boxer goes to the gym, does bag work day in, day out, month after day, week after week, month after month. He gets the repetitions in, he spars, he's done all the hard work. And now when it comes to execution in a real fight, he's able to perform. He's at his peak performance. Trading is the same. If you're looking to execute a trade, but you don't know why you're executing a trade, or you don't know what you're looking for, then what are you actually doing? You're just trading randomness to an extent. But if you can really nail down that, all right, this is what I'm looking for at this level. Here's the microstructure. Here's what I'm looking for. It could be a shift in microstructure. You're looking for trap traders. You're looking for maybe a liquidation event. You're looking for, forced sellers or forced buyers. That is a better reasoning to execute a trade, as opposed to, oh, look, this is a demand zone, so I'm just going to, I think this is worth buying. I think we're going to get a reaction. I think we're going to get a reaction. You don't know why, you don't know what you're looking for, but you think you're going to get a reaction. Well, that's just guesswork. What's the probabilistic edge of that trade execution? And I keep talking about it. So many people talk about, oh, look, liquidity grab under this high or under this low. Or if that's a liquidity grab, then why did price roll over soon after? So you get the notion. It's really understanding what is the shift in that inflection point in the market that is giving you a reason to execute a trade. And that's just one facet. That's just trade execution. We haven't even talked about what type of strategy you're trying to trade. And so, we talked about your B game is you're cutting good entries, you're front running entries, because when you front run an entry, you're then offside, then you puke it, then you think, oh, fuck, I'm actually going to execute again. So you've just pissed away a small amount of your capital. You keep doing that over and over and over again, you're going to get capital erosion. You're going to eat into your P&L. You're not trading efficiently. You're trading emotionally. And then your C game is just, again, dog shit trading. You're chasing price. You're copying other traders, right? How often do we see people on Twitter say, oh, hey, XO, why don't you ever drop any calls, but you never called it? Well, what are you doing? Just think about what you've just said. You are fucking copying other traders. You're not going to make it. I'm sorry, but you're not going to make it. I've never to this day ever copied any other trader. And the one time that I did was in 2017. And I just thought, well, this is a shit way of trading because I don't know what the fuck I'm doing. Like, why am I actually taking this? Because he said so? All right, let me follow him. And when that trade loses, oh, he's fucking shit. So the minute you take somebody's trade and you lose, all of a sudden that person is crap in your eyes. Well, guess what? As good traders have a 50% win rate. Some of the best traders in the world have a 40% win rate. Are they bad traders? No, they're not. They just understand the mathematics behind trading and the probabilistic nature of trading. So it's really about being on your A game. And the book, Mastering the Mental Game of Trading, talks about how to evolve your A game and your B game and your C game. That what you really want to be doing is that focus on your A game. And eventually, as you get better, your A game then replaces your B game, and your B game replaces your C game, and you've got an even more better A game. So your old A game becomes your B game, and you've gradually got to keep stepping forward as a trader, making those refinements, iterative refinements, getting better each year, every 6 months, every year, every 2 years. Eventually, where you were 2 years ago, say, it's 2025 now, or whatever your A game is, you should be striving that your A game eventually becomes, at some point later in time, a C game.
Yeah.
And you've got now this new elite level of A game, which is your A-star setups, which is your absolute brilliant best in setups, the ones that you only want to be taking. You don't care about anything else because you've seen this play out again and again and again and again. So it's like when I trade the range highs in the market, I know that I know that when price comes to range high, the old me in 2020 would have been, oh, range high, execute. Oh, shit, I'm offside. I'm going to cut this here. I'm going to wait for it to deviate and then get back inside. All right, execute again. And guess what? Price failed to break down. It goes even higher. I've just taken 2 losses in a row.
Yeah.
That was because I was just trading in some zone, but I didn't really understand what's actually happening under the hood. Fast forward today, where I am, people talk about trade the reclaim, trade the confirmation. I think that's just a bullshit way of taking a trade. I'm actually looking to execute whilst, let's just say, the deviation is developing, because I'm looking at the order flow, I'm looking at the positioning, I'm looking at whether people are forced buyers or forced sellers at a given level, and I want to take advantage of that inefficiency in the market. What you're trying to do as a trader is exploit inefficiencies in the market that are repeating over and over and over again. Once you understand what that pattern is, what that inefficiency is, then you've got to figure out, all right, how can I actually take advantage of this? Have I seen this play out not just once, 2, 3 times, 4 times, 5 times, but 10, 15, 20, 30? Have I gone back and back tested this across various charts on Bitcoin and Ethereum and Solana? Is this pattern playing out at the extremes of range highs and range lows? Yes, it is. All right, now how can I actually structure a trade around this? Do I just randomly place my stop at some level, or is there a calculated way I can place my stop at a given high or a low? Because if you think about it, what is variance? Well, we've talked about variance in the sense where if you're taking a trade, how often do we see traders talk about, all right, I'm going to take a trade here and I'm going to place the stop above this high?
Yeah.
Just think about that for a moment. Look how random that stop placement is. Because on the next 100 trades, you can't replicate that. Where for each stop low or stop high, it's going to change each time. There's no way of quantifying that. So sometimes you have to think about, this is something that I've been thinking about for the last year and a half, is that I'm trying to move away from this ideology of, I'm just going to put my stop at this high and then structure a trade around it. I think that's just a shit way of trading. I want more of a statistical edge, a numerical edge, a mathematical edge, where I can say, all right, I can take the day's ATR range and I can place my stop above X% of the ATR. Now I can apply that to 100 trades, and over 100 trades, I can see, all right, here's what actually happened. And I can backtest that. I can then carry that forward into forward testing. And I now have more of a systematic way of defining my trade execution with a logical stop placement that I can then review in my journal and slowly tweak. You can't do that if you're randomly saying, I'm going to just place my stop at this high and my stop at this low. That's not really being systematic. That's just a high degree of variance that it's difficult then to understand what your edge actually is, because some trades are going to stop you out, other trades they're going to work out. But if you have a way to define your risk structure per trade, per setup, per strategy, whether you're risking 0.2, 0.5 or 1%, now you're talking more about the probabilistic mathematical nature of thinking like a professional risk taker, as opposed to a high degree of randomness. So it's really about understanding your tactical game, your mental game, and this is where trading psychology comes in. I've probably got on here, I'm not going to read through this, is quite exhaustive, but here are all the A game points that I've listed out. Here's all my B game points that I've listed out, and here's all my C games. So when I'm reviewing the trade, when I'm in the trade, I sometimes quickly scan through this. Once I've executed the trade, I'm just watching it play out. I quickly make a note, all right, which one of these was I experiencing and how many are applicable to me? Because this is going to go into my trade journal. When I review my performance at the end of each week, at the end of each month, I look at all my emotional performance across each trade that I take, and each trade sits under a strategy. So I know the emotional response for a given trade and the strategy of, all right, this strategy is causing me to be hesitant. Why is that? Let me now go back to the charts. Let me do some further learning as to why am I hesitating when it comes to trade execution, or why am I cutting this trade because I keep doing this as a regular recurrence. Nobody is ever going to teach you that. No course is going to teach you that. No technical strategy that somebody gives you will ever teach you that. It has to come from within. Your trading performance, your evolution, and your development as a trader is you. Your biggest edge is yourself. And you're working on various edges which complete or combine together to give you an overall edge for a given strategy. That, for me, is what edge is. It's you. We are our own edge, because we're not systematic traders. We're not algorithmic traders. We are very much human decision makers, risk takers in real time. And so there's a degree of variance with our emotions. and it's trying to figure out how can I narrow the level of variance so I see more consistent performance moving forward. So that's mental game characteristics, that's tactical game characteristics. And then let's talk about the final part, which I think is so important in trading. This is from the book by Stephen Goldstein. I think it's called The Mental Game of Trading. I've built my trading frameworks, my trading psychological frameworks around these two books. So I really highly recommend everybody who I've recommended to has always come back and said to me, brilliant book, really, really good books. And really, when you think about trading, every time I take a trade, I view each trade as a life cycle, and it's so important to reset after every trade. Whether I got stopped out, whether I took profit, whether I cut the trade, I want to finish reviewing that trade before I even jump into the next trade. And this is where traders go on tilt, because they don't reset. They're acting, and they're acting, and they're acting again. Their ego has taken over their trading. And what does that mean? What can that lead to? Well, if you really think about it, this was Eduardo's P&L during this period, right? And at this phase where he didn't reset, he just shortcutted his entire process, his entire circuit. He failed to plan the next trade. He impulsively took it because he thought, oh, you know what? Price has come to a good level. Let me just hit it. Well, his short circuit in that resetting phase, eventually he goes through a period of tilt.
Yeah.
And that's what happens when you come off process. I personally experienced this 2 weeks ago. I broke my process. Bitcoin was trending down from when it went from 88 to 82. I tried to long 88K, even though every single indicator of mine, every single process would have said to me, EXO, this trade is not for you. Be looking for continuation.
Yeah.
What did I fucking try to do? Oh, look, I think price is oversold. I think this is worth a good buy here. Nope. Price went all the way down to 82K. And I took a 2.5% account loss because I was I was long on Bitcoin. I was long on Ethereum. And then when you look back and you think, fucking hell, what a shit bit of trading that was, because really, I didn't follow my system. I didn't follow my process. I would have been better off not taking the trade or just waiting for me to short it again if I got the short setup. Instead, I came off process. I didn't do my morning review. I was over trading because I was trying to get too intelligent. I was looking for a long back into a short, as opposed to, oh, if price bounces and comes back into my bounce, I'm going to short this again. Well, neither happened. So was that me following my strategy? No. Was that me following a process? No. Was I resetting after the previous set of wins? No. Therefore, I went on a bit of a tilt. And it's the reason for that, because I never reset. I never truly reset after the trade. And when we go back to what we say, was I really on my A game?
Yeah.
Or was I just on my C game? That was a C game trade. That is what's holding me back as a trader. And even my decision making, it's being distracted. I wasn't really focused. I didn't have patience in my decision making process. There was a lack of mental game plan or strategy. I'm not blaming anybody, but it is a lack of control. So it's very easy to pick out your C games. And once you see what's playing out over and over and over again, is it your A game, B game, or C game that's coming to the surface? You'll soon figure out where your flaws are as a trader. So these are the resources that I recommend that I really think are fantastic books. I talked about at the start why normal thinking never wins the trading game. I think Tom Hugard's book is just such a fantastic book, especially when it comes to adding to a winning trade. How often do we see traders, right, when they enter a trade and price is going towards the target, they start scaling out? Versus, really, if you want to make it big in this game, why don't you do the opposite and start thinking about, hang on a minute, I'm going to go for the jugular. Let me add to this trade. If there's a higher probability of degree of price going to your target, then add to it, Go for the jugular. Keep your risk static. You can still keep adding to a trade, risking 0.5%, and you can get some serious notional size behind that trade because not statically, but you are dynamically adjusting your stop loss. And as you're adding size to the trade, and it doesn't have to be significant size, right? It could be in small increments. You just keep adding, chasing all the way down. You could be using, like the Insilico terminal, you could be using a chase function.
Yeah.
But then in order to use that, you cannot just rock up to the chart on a trade and think, oh, you know what, today I'm going to use a chase function, because you never back tested that.
Yeah.
You don't know what that looks like. You haven't got a strategy for that. You haven't got an execution game plan for that. So why are you now all of a sudden think, oh, look, here's a cool feature on Insilico Terminal. Why don't you use chase limit? Well, have you actually back tested that over 30 examples of over 30 scenarios? No, you haven't. So again, you are trading randomness.
Yeah.
You are not trading a trading process. You are not trading a trading structure. You are literally just second guessing what the market is going to do, because you don't have any statistical way of defining or quantifying your performance. So again, it comes down to, is this something that you've verified a number of times, back tested, forward tested, sample sized in a live environment on a small account, where you've done this over the last 20 times? Because you're going to learn more from that than you will trying to actually do it in a live environment with very little performance review, with very little back testing, very little forward testing, because you are then at that point trading something that you haven't, you're performing in a way that you've never performed before. You might get away with it. It might be one-off. It might be an anomaly. There are certain conditions that you can't plan, you can't trade. I understand that. That's why you've got a level of flexibility. If this is something that you're trying to do again and again and again for the next 1,000 trades, well, how do you know this is going to work for you if you haven't back tested it? So that's the psychological aspect. That's the mental aspect. That's kind of the whole, the way I've really come to think about trading. Really, in a nutshell, when I think about trading, how could I summarize it best? You are looking for market inefficiencies that play out over and over again, and you are looking to exploit those inefficiencies by figuring out what happens every time, what are the variations of this happening, like what are the subtle differences between exhibit A, exhibit B, exhibit C, and how can I trade this? How can I structure a trade around this? How can I structure my stop loss? What's my position sizing going to look for this trade? What kind of targets am I working for, right? Quite often we see crypto traders go from A to B, from supply to demand. Well, what if you can chalk off, which might be a 2-hour trade, but what if you can chalk off a 4-hour trade where you're covering less than half the distance of what you used to do before, because you've now managed to really refine your execution. So edge is an execution. And people talk about having a trading strategy, but nobody ever seems to talk about execution strategy. You've got to have trading strategies, patterns that you play, and within each of those strategies, you're going to have 2-3 ways that you execute a trade. Is it a funding thing? Are you looking for a drop off in open interest and a spike in liquidations? Are you looking for, like I said, forced sellers, forced buyers? Are you looking for tapering of a volume profile at the edge of a composite, or at the edge of a trading range? Whatever it is, figure it out, back test it, look at how you can structure your trade around those. And then we go into routine. Obviously, I think it's a nice segue into routine. But before we do, I don't know if there's any questions. I've been rambling on, so
maybe we can just go back another slide to the resources and just read them out for like the people that are only listening.
Oh, for the resources, yeah.
Yeah. Because I think they're
all right, so,
good to know.
Yeah. So in terms of the further resources that I really highly recommend, I think there were 4 books. There is a 5th book that I'm reading, which I probably won't mention yet until I've reviewed it. But the 4 books that I think were very, very impactful on my trading over the last 3-4 years. The first one is Mastering the Mental Game of Trading by Stephen Goldstein. The second one is The Mental Game of Trading by Jara Tendler. I think these two are really central in. So I've got the technical ability, but then how can I encapsulate my trading from a psychological performance perspective, mindset performance, understanding that it's the mental game of trading which is actually going to make or break me, not just my technical skill set, but the two combined. And like I said, you've got to have a level of positive expectancy, an edge, a strategy where this then becomes applicable, because now you're applying it to something that you're looking to repeat in the market, as opposed to, oh, I need to work on my mental game of trading because I keep losing. All right, you keep losing, but is it because you're following a strategy? Is it because you're following a process? Or is it the case that one doesn't exist? And so if you try to go down the psychological route, it's not really going to make much difference, because you're not able to incorporate the psychological aspects of your trading into what is a clearly defined blueprint. And if you can't explain, and I've got a question that I always say to people, if you can't explain one trading strategy within 5 minutes, then do you actually have a strategy? Do you have edge? You can't have edge because you don't have a strategy. And if you can't explain your strategy, then you need to stop trading. You need to go back to the drawing board like I did, sit down and work out and read the market, understand the market, see what patterns are playing out, and then decide, oh, do you know what? This happens again and again and again. It's the same with humans, right? When we see Black Friday is around the corner, are we really going to go purchase some electrical goods 1 week before? Yeah, some people do. That's fine. Other people want to buy value. Well, what's the pattern there? Well, you know, Black Friday's coming. There's an opportunity in the market for you to actually buy that watch at 30-40% or buy an iPad at a heavily discounted price. You're going to take advantage of that because that doesn't normally happen. It's the same with trading. You see these inefficiencies, you see these opportunities. Well, have you seen them enough times to think, oh, do you know what? I need to figure out how to actually trade this because I can make some good money out of this. And therefore, you're now thinking about trading professionally. You're thinking about the game in a different dimension than randomly just rocking up, oh, here's support, here's resistance. Let me take this trade. And the beauty of that is that once you've then got the trading strategy, you can then create a filter around that. So when these set of rules occur, then let me know which trades I should be looking at, which I need to take or act upon. And so the two work together now. Now you have, instead of some random filter where you chase some momentum, that there's actually a real purpose behind you developing that filter because it's derived from your strategy. So instead of looking for trades across the market, let's just say you trade equities, thousands of equity pairs out there, you now have a system which is going to bring you, oh, you know what, XO, these three trades are the ones that you should be paying attention to today because they've just given you a trigger to think about executing your trade. The breaking out, or they've just had a surge in relative volume. Something's happening. Go check it out. Look at the volatility. So they're the two books. And the other one is Alpha Trader by Brent Donnelly. And then The Best Loser Wins by Tom Hugard, which I think is another brilliant insight into somebody who is a high stakes trader. You know, somebody who isn't just trading $1,000 account. We're talking about somebody who's putting on some serious size on trades and has been doing it at a high level for many, many years. And if you want to learn to become better, then you've got to look at what the best have done in this game and take it from there and try to replicate and emulate their process, their mindset, not their strategy, not their technical skill set, but their core genetic, mental, emotional framework that has led to them being successful and where they are today.
I actually have another question.
Sure.
Most of my questions have been previously taken by you already because you've been pretty extensive, which I appreciate a lot. But I'm thinking, because you've mentioned before to me that you are interested in more algorithmic traders. Would you say like the end game of everything that you're describing here is becoming an algorithmic trader, or is it still going to be discretionary but just like way more systematic and refined? Does that make sense?
Yeah, it's an interesting question. I think where I am today, look, I come from a software engineering background. You know, I was a software developer for 10, 12 years. I kind of fell out of love of coding. You know, I kind of got bored of it. 2020, I quit my career to go full-time trading. But now with the emergence of ChatGPTs and LLMs, it's given me a whole new lease of life. What would have taken 3-4 weeks to figure out is taking a matter of days to put together as a prototype. And so I'm not looking to become a quant by any means, but I am incorporating a high degree of scanners, screeners, filters, custom built by myself, for myself, with push notifications, because this is information edge. This is systems that are aligned to my strategies, that I'm looking to trade the opportunities that I want to trade. And so it's about finding those opportunities in the market, finding those inefficiencies in the market. And then when I think about it from a systematic approach, it's more, well, we live in a time where, raw data isn't just the only edge. It's about filtering that data, understanding that
Yeah.
data, and where real edge is found. And so that's where I've been transitioning towards, building tools in AI to understand my trading journal, my trading performance. Can I extract all the trades that I've journaled into a CSV file and then put it through some LLMs and then query it and filter it and find out more about my own trading performance? So that's another insight that I feel people could tap into to really get some insight. But to get to that level, you have to journal your trades, obviously. And then I'm trying to build systems that track volatility, regime changes, that show a shift in structural levels, that monitor statistical patterns, that scan for certain setup conditions. And then it's not just about trying to find. I'm also, like I mentioned, I took a trade when I tried to long Bitcoin and Ethereum on the way down. Well, I've started to work on that because I realized that I need to keep that shit out of my game if I
Yeah.
really want to hit true elite performance. And so I've built out a filtering system now to alert me, not alert me in the sense of, oh, here you go, here's an alert. It's just to show me that, you know what, keep out this trade. It's visually telling me that this trade isn't for you. Keep well away. So sometimes it's about creating filters that keep you out of bad trades, and then other filters that bring to your attention some really good trading opportunities. And so the whole edge here is really decision making edge, and you're reducing that aspect of human variance, that human variability that creeps in our game time and time again. And so yeah, that's why I think the power of LLMs and GPTs and automation comes in, and then you can take it further. The other thing that I'm currently trying to revamp is to create an automated dynamic trailing ATR based stop. So, if I'm away from the screens, if I'm away from the desk, I don't have a hard stop or a static stop. I can switch on the algorithm, and it will incrementally keep adjusting my stop based on some parameters. And that's something, again, that I'm backtesting. I'm trying to figure out how to build that. And it's no different, I think, when you start thinking in a quantitative way, in a systematic way, as a discretionary trader, you'll actually realize that implicitly it enforces you to think about trading in a different dimension. It really opens your mind to thinking, actually, you know what, I really need to think long and hard about my trading now, because I'm really trying to get as much edge and extraction out of my performance as opposed to just doing what everybody else is doing. And it comes back to, what are you doing different that's going to allow you to become a better trader? Not you against other people. You're just competing against the market. It's about you against yourself. And that's where I think technological edge really comes into play.
Yeah, that makes sense. I think we can go on with what you have further.
Yep. So I think we'll talk about routine for 2-3 minutes. Really, if you think about it, routine is core to everything that I do. If you recall the example that I gave you, that I took a trade on Bitcoin and Ether, I lost. Why? Because I bypassed my routine. I've always said you've got to have a routine. If you don't enjoy it, you're not going to do it. There's no point in creating a training manual and say, oh, I've just made my daily routine, and then 1 week later, you haven't even looked at your daily routine. You haven't even done anything about it. Well, were you just playing mental gymnastics to make yourself feel better about the fact that you've written a trading routine, but you're not following it? Well, that's not very helpful. So it's something that you have to understand about yourself. What's going to enforce you to remain? This is discipline. When people talk about discipline, when people talk about patience, well, what does that mean? You've got to have a systematic way to approach that. And for me, that's having a routine. Without structure, without consistency, we're setting up for failure. And so why is a routine important? Because it builds consistency. It sharpens your focus. It improves execution because you're thinking about the trade. You're trying to get into that flow state. You're trying to get into the zone of trading. You're trying to be in sync with the market. You're looking for market rotations. What environments are you in? You're trying to gauge the market sentiment on a daily basis. What is the structure telling you? What is the momentum telling you? So everything here that I've written is exactly where I broke when I didn't even go through any of this when I took a losing trade. So it's very easy for me to rectify that, but there's nothing more frustrating or annoying than actually taking substandard trades that have nothing to do with who I am as a trader.
Yeah.
It's just shit trading. That's it. And so the key steps of a daily routine, what does mine look like? So I kind of summarize it here. It's reviewing the process, reviewing any overnight positions, reviewing any limit orders, stop orders, whatever it is, understanding the current market context and volatility regime. I think this is really important, which we'll touch upon. Building situational awareness, understanding yourself really and the situation that you are looking at in the market. Creating a focus list, being organized. That is where scanners and filters come into play. Building the game plan. All right, you've mapped out your levels. You looked at market profile. You've looked at the flow. You looked at the book depth. You've looked at the overnight 24-hour volume. Were there any liquidations? Were there any news events? Is open interest building up, which is going to cause a risk to the market? So it's just having awareness about the domain that you're operating in. And then obviously trade execution. What are you looking for to execute that trade? What specifically do you need to see? And this is where you have a level of implicitness in your mind because you've seen this play out again and again and again from a trade execution point of view. You know exactly what you're looking for. Is it a 3 drives into resistance? Is it 3 drives into support? Are you waiting for that 3rd drive to take out the previous low with aggressive selling into those lows to get long? That's a really logical way of thinking about the market when it comes to trade execution. You're trying to anticipate, if price does this, here's what I think could happen, and here's what it could probably look like because I've backtested this over 30 times as opposed to, price is at support. I think I'm going to punt along here, stop below this low. Yeah, fine, you can do that. But what if you can enhance that execution from being a 3-hour trade to a 4-hour trade because you've really understood the context of price when you're looking to execute that trade? And not only that, you don't have to take a full 1-hour loss because you realize that, all right, your execution was on point. The market did what it did to the point of execution. But half an hour later, there's a news event. Now, all of a sudden, you have to be questioning, what is the market doing? Where is it trying to go? Is it doing what I expected it to do? Or do I need to change my plan? That's what you call having a level of adaptability during trade execution because you're still managing that trade at the point of execution and soon after execution until it's pushed away. And then obviously, at the end of the day, write down what you did well, what you didn't do very well, and sometimes you can be mentally fatigued. Come back the next day. Don't take another trade until you reviewed your performance from the previous day. Or if you missed a trade, why did you miss a trade? Were you out? Were you disorganized? Did you not have alerts set? So that's part of a routine for me.
Yeah.
And obviously, I don't want to keep delving on that. I'm sure people can figure it out what a good daily routine would look like for them. Risk management, obviously, we're not going to talk about this too much, but you just got to, you can pause or watch this. But when it comes to risk management, there are several facets of risk management, which I feel not everybody, but let's just say a large part of us ignore. When we think about risk management, what do we think about? We just think about money, how much money, that's it. But really, risk management is more than just that. It's your psychological risk, your emotions, your fatigue, your stress, your cognitive bias. All these are going to impact the way you execute a trade. And you've got to remember, you control risk, not outcomes. The markets are a level of uncertainty. Trade setups fail. So when trade setups fail, you can control how much you lose. You can't control what the market does, but you certainly can control, absolutely, you can control how much you're willing to lose per trade. If you follow your control risk procedure and you follow your process. And then you've got drawdown management, with drawdown, if you take a 30-40% loss on an account on one trade, what does that come down to? Was it down to the fact that you didn't follow your process, your system? Well, it's psychologically going to impact you because now you're in a really shit state and you've got to figure out how you're going to make it back. And so it affects your psychological performance moving forward. Your confidence drops. It takes much longer to recover. I took like I said, I took a 3% loss. I stepped away from trading because I thought, fucking hell, I don't want to take any more shit trades. I just need to take a break. I think I'm fatigued here. I've probably been over trading. I've taken so many trades. I've done really well. I'm at that point now where I'm starting to give it back. I'm coming off my process. I need to step away. So again, situational and awareness. I don't want to revenge trade. I don't want to try and make it back on the next trade. I'm just going to step away. Let me take a few days off. I'll come back to trading the market next week. And that's what I did. Started off with a very decent win, made 1% back of the account loss. But that's not how I look at trading, because I look at it from every week as a fresh week. Whatever happened in the previous week, I've journaled, documented, logged, done. Next week, here is my target. I'm trying to operate at 1.5% account gain per week, and with a maximum drawdown of 5%. That's rolling drawdown. So really, I don't care if I've taken 10 losses and only lost 2% of my account. I don't really care about that, in the sense where you see a lot of people talk about, oh, if you take 2, 3, 4 losses in a row, you should stop trading. I disagree. I think if you've got very disciplined risk management, what if I've taken 6 losses in a row and all of them equated to just a minus 1% account loss because I've just taken small scratches? Should I stop trading now? No. I followed my process. I followed my system. I'm going to go into the next trade because I've got very good control of my risk management. I'm not going on a tilt. I'm not losing control of my emotions. I'm staying very structured and very disciplined. And the risk management aspect of that works simultaneously with the emotional side of trading from my own experience. And so when you appreciate these two, I think it really helps you think about, all right, well, I've got to appreciate risk management. It works the psychological aspects of trading. Now I'm going to deploy it on the strategy. Here's my execution trigger. You feel far more calm and collective in the way that you trade. And it protects your edge. It ultimately protects your edge. What is a very good edge, right? Just because you take one big loss, does that mean your edge is shit? No, it's just that you're shit. You didn't follow your process. You didn't follow your risk management system, right? So it's a case of just because you're taking losses on a given strategy, why are you taking losses on a given strategy? Is it emotional, or is it really technical or mental, or what was it? So that's another reason why you could give me a brilliant winning strategy, and yet for me that could be my worst performing strategy. It's a losing strategy. Why is that? The strategy is fine. It's the person who's operating the strategy. That's the issue right there. And so it protects your edge. Risk management protects your edge. You rely on execution. You have a consistent way of trading. It gives you longevity in the game. And then if you look at elite traders, they all understand Kelly criterion. They all understand bet sizing, position sizing, thinking in bets. They all know how to grade their setups. And if you don't journal your setups, how do you know how to grade them? How do you know which ones are your best performing strategies? And so top traders, elite traders, understand expected value. They understand on their A setup how much they're willing to size up, how much they're willing to risk. And elite traders like Tom Hugard, who adds to his winners, that's dynamic position sizing right there. It's not one entry with a stop and a target. That's just very, very static. And I used to be like that. That's how I used to trade in 2020, 2021. And you realize, well, this is just what everybody else is doing. Surely there's got to be more to becoming an elite trader than just entry, stop, target. And it is. I think it's being dynamic, where your risk is always dynamic. Your position sizing is dynamic. Your notional size can be dynamic. Let's just say for an example, I execute a trade with 0.5% risk. Price pushes away from my level. It comes back on me. It's now against me. I've got two choices. Do nothing and let the market play out, fine. Or I can reduce my risk but still keep a level of exposure on there. So I'm just reducing how much I'm losing all of a sudden. Because if it goes further against me, I've not taken a full 1 hour loss. I've taken a half hour loss just because I reduced the risk as it was going against me. And that's where thinking dynamically about risk comes into play, as opposed to, oh, fuck it, I'll just take the loss. I'll just take the 1 hour. It's only 1 hour. No, if you can save money, then do that. If you can protect your P&L, so then that when that setup occurs again, you can hit it just as hard with conviction and confidence that you don't mind taking a few scratches. And so you preserve your mental state, because it depends who you are as a trader. Some traders like to have a high win rate, where each win is not really significant. Other traders can operate at a 25% win rate. So imagine that you're losing out of every 10 trades, you're losing 7.5 trades, and you're only winning on 2.5 trades out of 10. That's out of 100. You've lost 75 trades. You've only won 25. Psychologically, that would fuck up a lot of people, because they just keep seeing loss after loss. But if you can embrace the fact that you have phenomenal elite level risk management, where those 75 losses, you've only lost, let's say net minus 9% of your account. where the 25 winners, you've returned over 100% return on equity.
Mm-hmm.
That is phenomenal performance over a year. And so really, it's about, again, it comes down to understanding the maths behind your performance, the mathematics as to who you are and what your risk appetite is and what your psychological pedigree is as a trader. Can you handle a low win rate system? So most people probably can't. Other people rely on a high win rate, but where the wins aren't really exceedingly large, probably at 2-to-1, maybe half an hour, if that. Consistently over time, where their accounts are slowly churning higher and higher and higher with a few drops and another shift higher. Just controlled, gradual growth is essentially what I'm saying. So key risk concepts. You're a risk manager first, a trader second. Know your numbers like your life depends upon it, because in this game it does matter. You can't build consistency if you are always recovering from deep drawdowns. Okay, that's going on tilt. You are up against it. Every time you take a large loss or a big loss, it's really setting you back 10. And I think of that like the snakes and ladders game board, where you roll a dice, you go 6 steps up. The minute you fucking land on a snake, you're 30 steps back down. You have to start again, and you've got to avoid those snakes. And those snakes is you with your poor risk management, and lack of discipline, and lack of structure, and lack of patience, because. Again, people talk about, be patient in trading. Well, a lot of people think being patient means waiting for the right setup. No, it doesn't. It's not only that. Being patient means, can you do this for the next 1,000 trades over a 10-year period? Because if you can, there's a very good chance that you've got a very good career ahead of you. It only takes one bad decision to come off process. And then when you structure risk properly, you can be wrong a lot and still make some serious money, which is what we've touched upon. Win rate, risk reward, understanding expectancy is important. Stop obsessing over being right. 50% win rate, 40% win rate are phenomenal if you have positive expectancy from those. All right, so strategy creation. This is probably going to be the last segment that I cover. Now that we've built the foundation of self-awareness, understanding the uncertainty of markets, understanding what is edge, what is expectancy, what does the level of structure look like? Understanding how the emotional facets can impact our trading. We can now talk about trading strategy creation. And so I'm not going to go into too much detail, but like I said before, when you're looking to create a strategy, really all you're doing is looking for inefficiencies in the market, and you're trying to exploit those inefficiencies. And so you have to understand the environment in which they occur, how they operate, and how you can trade around them. So the 15 principles, and this is the template that I use every time I try to create a new trading strategy. This is something that I go through. And the first purpose is to define the core hypothesis. And I'm just going to quickly run through this. But what does this mean? Define the core hypothesis. It starts clearly by stating why the market should behave a certain way under specific conditions. So you're really understanding how the market is playing out. Is that following a set of moving averages, where the moving averages and the degree of the momentum or the bands are increasing? That tells you the momentum is picking up. So should you be range trading that, or should you be looking for continuation momentum? So define and understand, why the market should behave in a certain way under specific conditions. And that is where it leans into identifying point number 2, or the second principle, identify the market condition. So many people try to deploy a strategy in the wrong environment. The problem isn't the strategy. The problem is you. You're not recognizing the volatility regime that you're in. And so you've got to link any strategy to the high level context, key zones, structural levels, volatility regime, sentiment. Maybe it's a time of day. We know that during New York session, Bitcoin volatility generally picks up. Principle number 3, anchor the setup to the context. So this is it. This is what's important. So now that you've defined the volatility regime, you can now say, all right, this is the type of strategy that works best in this environment. And there are 5 types. It's either going to be trend, it's going to be a range, it's going to be a breakout, a rotation, or a mean reversion. So now you figured out, all right, this is a trend environment, or this is a bracketing environment, or this is a a range environment. I figured out the volatility. I know that by measuring the ATR, I now know what type of environment I'm looking at. I don't think we're going to break out into a new trend. I think we're just going to oscillate between value area high and value area low. And I'm looking to trade around the edges of that volume profile or market profile. And then I'm looking to understand, all right, now that I've understood the context and the strategy that I'm trying to trade, what's the entry trigger? So define the exact signal that confirms your entry. Is it a pattern? Is it a level interaction? Is it a confirmation on the flow? Is it a structure break, on the 1 minute time frame? Is it a Renko chart? What is it? Is it an awesome oscillator? What is that gives you that shift or inflection point to start thinking about the entry trigger? And then principle number five, establish the execution rules. Understand the timing of the execution. What type of order types are you going to use? This is where using something like Insilico Terminal makes sense, because what type of execution methodology are you now going to apply? How are you going to scale into that trade? What type of size are you going to look to run? And is your execution consistent? Or do you have 2 or 3 varying execution strategies depending upon the environmental context? And I'll give you a classic example. If you know that price is likely to trade in a range and you get a very fast move into the range high with a swing fail, and you realize that was a cascading liquidations slamming into some passive asks, and price pushes away very quickly, how are you going to execute on that? What is it that you're looking for to execute? Sometimes you have to take an aggressive execution where you might have to hit that market. Other times you might say, all right, I'm going to hit half that market and I'm going to switch on a limit chase only up to this point. But then you need to backtest that, replay that, run that through over 20, 30 samples so you know what that feels like, what that looks like, how that plays out. And then obviously you've got to manage your risk around that. Where's your stop placement? In which instances have you been wrong on your back test, on your forward test? So again, it's all about pattern recognition in every single aspect of trading, that you've seen this enough times to execute with conviction, but execute with conviction and that you know exactly where you're likely to be wrong. Point number 7, back test with discipline, exactly what I said. Run the strategy through historical data. If you do this on a back test and you record your performance, you can run that through Monte Carlo simulation tests to see how it performs over 1,000 simulated trades. But don't curve fit it. Don't override the signals. And then principle number 8, measure performance metrics. So track the expectancy of that trade. If you've taken that trade and you say, all right, I'm going to target 3R, but you've noticed that 80% of the time is on the back test, it doesn't even get to your target. Well, turn it down to 2R. You've increased the expectancy of that trade now, as opposed to, I'm going to hit a 3R trade. I'm waiting for a 3R trade. Price goes to 2R and it comes all the way back to your entry.
Yeah.
The reason it did that is because you didn't understand what you're trying to achieve out of this setup. You've put all this emphasis on the execution part, but you've given very little thought to the profit-taking aspect. Maybe you took a trade at the range high and it lined up with some VWAP bands and you're looking, the second standard deviation, and you're looking to trade it back into the VWAP price level. What if it doesn't get there? What if it gets to the first standard deviation only? But then you realize, hang on a minute, every time I've gone through my sample size or backtest of 50 trades, there's a high degree of probability and expectancy that price always mean reverts from the second to the first before it gets to the VWAP level. This is a really good trade. Maybe I can take 50% off of this level. Or maybe I can maybe this is an edge I can develop. Maybe this is all I need to trade. A mean reversion from third standard deviation to the first standard deviation. If I can do that over 1,000 trades, I've got a good trading career ahead of me with a good level of expectancy, given that I've understood the environmental context, that we are in a bracketed environment, not in a trend environment. So again, this is where environment context comes into place and measuring your performance. And then, like I said, forward testing real time, that's common sense. Now that you've back tested it, you try it out in a simulated environment, a demo environment. Maybe you get a $100 account and just trade $1, trade position sizes over 30 trades over a 2-3 month period until you get confidence, right? Just like you would In a boxing ring, you go to a boxing academy, you're not going to step into a professional fight. You're going to have many, many sparring rounds with other amateur boxers before you
Yeah.
actually go into a live environment. It's the same with trading. Establish principle number 10. So that was principle number 9, forward test in real time. Principle number 10, establish minimum sample size. Again, we talked about, collect at least 20, 30 occurrences, not of just a trade strategy, but of the execution as well, around these edge zones where you're looking to operate, to validate robustness in this trading strategy and trade execution. Point number 11 is then evaluate the strategy fit. Assess whether the strategy matches your personality, your strengths, your schedule, your decision making. Maybe you're a day trader, maybe you're a scalper, maybe you rock up to the desk and all you want to trade is a New York session on Bitcoin or equities. Then focus on that time frame, focus on the window. There's no point in saying, "Oh, look, I've tested all these. Oh, look, I found some brilliant edge," but that edge only ever happens in the Asia session. But you're turning up to the desk in the New York session. You're waiting, and it doesn't happen. Well, does that actual strategy fit you, your lifestyle, your personality? And what's the time? What's the average time where this, or what is the time of the day that this execution sets up? Do you track that? Have you defined that? So again, all these are metrics that I think are important to recognize when it comes to strategy creation. And then point number 12, break the strategy into high, medium, and low quality versions so you know when to size up or size down. So remember we talked about the A game, the B game, the C game?
Yeah.
Well, if this is a strategy, but it's falling into your C game, what do you need to do then to get it into your B game to eventually progress it into your A game? It's going to take more training, more repetition, more back testing, then running it forward testing because you've made those subtle changes. Now you're looking to reenact those in a live environment. Principle number 13, understand the reward structure. Determine whether the strategy relies on big winners, or is it frequent small wins, or is it asymmetric reward to risk profiles? 14, stress test the strategy. So we talked about how does this perform in a volatile environment. So we saw 10-10, right? If you're looking to play, oh, look, prices come down to, the third standard deviation of VWAP bands, I'm going to long this, and price shit through that level. Well, that's shit trading because you fail to recognize the volatility shift. And so therefore your strategy does not work in an environment where the volatility regime has changed. Really what you should be thinking is, hang on a minute, I shouldn't be looking for a VWAP mean reversion strategy. This is a trend strategy. I'm looking for continuation. So again, that's where you then can start thinking about, all right, so this actually fails in this environment. I need to start thinking about a trend continuation strategy now. And so it evolves. And then the last part, build, principle number 15, build and maintain a playbook. That is basically a living document, database of a given strategy. You've gone in the charts, you've collated a sample size of 50 examples of this execution or of this strategy playing out over and over and over again. But not only that, as you forward test it, as you trade it in a live environment, you can only store so much in a journal. But there's no reason why you can't tag your trades in something like Evernote or OneNote, and then use that tag in the Evernote and also log that in your trade journal so that you can then reference that. All right, here's a trade I took, trade ID number 12345, and in my Evernote, it's trade ID 12345 under this strategy name. You can now look at all the screenshots or screen recordings that you took to review your performance. Just like a boxer, just like an MMA fighter, you've just had a five round fight, a 12-round fight. Is that it? Are you just going to go into the next fight, or are you actually going to review your fight? Are you going to replay back your fight to see how you performed, what you did well, what you could do better? That's how you improve. Not by taking more technical courses and joining more paid groups and going to every trading seminar. It's actually doing the work that most of us, to begin with, never thought of doing or wanted to do. And so for me, that is the summary of everything, throughout this process of trading over the last 9 years. This is where I've got to. This is who I am as a trader. This is how I approach trading. This is what I wish I knew when I started trading. And moving forward, this is the foundation of what I believe for myself. I'm not saying that this is going to be the foundation for other people, but again, I'm just sharing my own experiences as to this is what has been key for me to get to where I am today, to go to that next level, to get to the highest level possible that I can achieve before I walk away from this game. So that's what it comes down to for me.
Yeah, that makes sense. Thank you very much for
All good.
all of that. That was very it was very different from what I usually do here, but I'm very
Yeah.
I think it is very you really gave the whole playbook from a really professional lens, which is often quite underappreciated on CT, I feel like. Because
Yeah.
crypto also skews our perception of trading, what trading is a little bit with meme coins, mostly it's just gambling and stuff like that. But I think you really did a good job in putting together what it takes to be a professional and long-term successful at trading. And that is more than just looking at charts, indicators and whatever, but really understanding not only the market but yourself.
No, I agree. And I think you're right in the sense where crypto kind of warps your perception of trading. I think if I started trading equities, FX, or indices, I think my approach to trading would have been different.
Yeah.
Because we come into the space of trading meme coins and altcoins, and we see other people making shit ton of money, and it's circulating on social media on Instagram, right? It's I want a bit of that too. So and so made $100,000. He only put 10K in, but he's made $100,000. I'm gonna buy 5,000 worth of Shiba Inu, right? Or Brett or whatever the shit. And so we're just trying to replicate the success of others without really appreciating that's not actually trading. That's just pure speculative gambling at best, where the chances are you're probably going to lose a lot of money doing that. And so, like I said, I was one of those people. I used to marry the fundamentals. I used to think every project that I bought in 2017, like Neo, Lisk, Stratis, is going to be game changing.
Yeah. We've all been there.
So unfortunately, that isn't the case. And then you come to realize that, look, I'm sure a lot of people did very well on meme coins, but that's not my strength. I know that my strength is everything I've worked hard towards over the last 9 years now is coming to fruition over the last 2, 3, 4 years.
Yeah.
And I'm more excited now about my performance as a trader. I'm more excited about where I'm going to be in 3, 4, 5 years' time, knowing what I know now and continuously working on my game. And there's nothing that gives me more joy than journaling my trades and actually looking at my performance. It's like I said, you've just been into a fight, into a UFC fight, or you've been playing golf masters as a professional sports player, or you've just you whatever it is you play, football, you're a professional footballer. The chances are you're going to review and watch your own performance to see how you performed on that given match day, on that fight day. I see trading the same way. I really enjoy looking back at how I performed during this week and knowing that this 1 week is not going to define me or change me. But if I've had a good week of trading, this is what I need to do for the next 1,000 weeks to get to the end goal of being a trader with positive expectancy, with good risk management. I do not want to make a lot of money with huge drawdowns in between 30, 40, 50%. That to me is not really operating as a really professional trader. For me, I want to do it in a systematic way where I've got very, very clearly defined risk. That if I can do this with $1,000 account, if I can perform over 100 trades on a $1,000 account, I can probably do it with a $10,000 account or $100,000 account or a $1 million account, because I know that I'm looking at percentages. I'm not looking at P&L. I'm following a process that has worked for me time and time and time and time again, that I know I can scale this now, as opposed to get into, say, high net worth, but with a lot of variance, that every time I take a trade, I'm very much on edge. I'm very nervous because I'm scared of taking a big loss, but I could take a big loss knowing how I don't really have a systematic way of trading. So I think that's the realization. Once you realize that, once you start really thinking about the probabilistic nature of trading, thinking in mathematics or the maths of trading, and understanding edge and expectancy and all the various components that I've discussed today, it really sets you off in the right mindset moving forward. that whatever you did before without a process doesn't mean shit. You might be able to read a chart, doesn't mean you can trade. You might be an order flow guru on footprints, doesn't mean you can trade. You might be very good at psychology, but you're shit at technical analysis, doesn't mean you can trade. You know, you might be a very good risk manager because you only lose small amounts, but you haven't got anything demonstrable that you've got positive edge. You're just a very good loser, but you're not good at winning. So every single facet comes together to hopefully evolve into continuously learning and evolving as a trader.
I definitely really appreciate all of that as someone that loves the art of trading, and I feel like a lot of our listeners will also really appreciate and enjoy this episode. To wrap it up, do you have any final words that you want to share with the listeners, the watchers?
I think I'm looking forward to the Insilico terminal, using that more often, and I think that's a really good way of approaching trading, because if you can play around with the various execution strategies, and if you can start journaling your trades, it will start forcing you to think about trading in a different perspective as opposed to opening up your mobile phone and just punting on a trade. You won't remember what you did 2 months' time. But I think with a level of systematic purpose, having a process, and using the right tools for trading, you know, with a terminal, with a journal, with a framework, then hopefully it'll help you step towards the direction that you wish to progress in.
Yeah, thank you very much for coming on today. Thank you for
Thank you.
explaining everything, and bye.